It's Dave Burrows. I am CEO and Chief Investment Officer here at Barometer Capital Management. I want to welcome everybody to today's call. I've asked James Callahan to join us, one of our key portfolio managers, to talk about a couple things. As usual, we're going to take a quick flyover from a high level and take a look at what's going on in markets. Over the course of the week, of course, we're getting closer to the Fed's next meeting. And I think investors are considering the impacts of what potentially could be a Fed cut. We have been seeing easing across the globe, and that's having an impact on risk assets everywhere. September is often a difficult month. It's the most difficult month of the year statistically. But we're going to push that around a little bit and see what we can read from some of the market internals. As to what we're getting from the market as input. Of course, the second quarter earnings period is now over. The votes are in, and in general, earnings came in much better than expected. Revenues came in better than expected as well. We've been watching earnings revisions to see what, if anything, has changed. And so without further ado, let's jump in. Of course, we've been in this structural bull market for a long time, 12 years. No sign that that's coming to an end. Of course, we've come down and touched on this rising 200-week moving average a number of times. Each time felt a little bit scary, and each time we fielded a few phone calls. But each time the market was able to hold and rally, as we did earlier this year. So now we're sitting at 6,400 on the S&P 500. August was positive. We've started the month slightly negative as of just before the call started. The S&P was down about 0.9 of 1%, sort of irrelevant in the scheme of things. But since this bull market began, the market's up 322% over 151 months, which is solid, but really doesn't compare to the bull market of the 80s and 90s. Coming in at 217 months and about 1,300%. So as a note, late in a bull market, you often get an inflection where things go higher. We'll see whether that happens this time. But there's nothing that you can take away from this chart that says that anything other than we are in a structural bull market. So as I mentioned, seasonally, if we take all the 2-week slices of the year since 1950, first half of September, one of the weaker periods, and second half of September, the weakest period. September down on average 1.17%, declined 56% of the time since 1927. But there's really no sign of that as we sit right now. So of course, this is the low in April that came around Liberation Day. And the market's clawed its way back and went on to make new highs. Now, we've talked a little bit about this. When you come into a weak period in the calendar, it matters the footing that the market is on to begin with. So we end August with a positive month. And when you ended with a positive month, it tends to be that you have a positive September. If you come in on a weak footing, it tends to be that September, would be quite weak. And if you took all the observations, slightly negative. So we have that in our back pockets. We don't make decisions based on that, but it's always interesting to consider. If we look at the Nasdaq 100, it also has climbed its way back and made new highs, off a little bit over the last couple of weeks, so a little bit weaker. And the equally weighted S&P, did come back and make new highs. We dipped just down below that level as we speak. A little bit weaker momentum in the average stock in the S&P, worth watching. But, certainly we've had a little bit of an acceleration in the Russell 2000. If you remember, not this past Friday, but the Friday before, we had a 14-to-1 up day, which tends to correlate to stronger periods to come. So we'll see, but that was certainly a very strong, up day, and we'll see whether we get some follow through off of that. Now, we've had lots of conversations with clients over the last little while. We're doing sort of quarterly reviews. And if we haven't spoken to you, we'd love to. And one of the questions we're getting is, people perceive that valuations are fairly high in U.S. stocks, and if you look at certain measures, like PEs, they're high, certainly relative to higher periods. This is April of 1999. If you take a combination of trailing price earnings multiple, forward price earnings multiple, the CAPE ratio, price to book value, price to sales, a number of these, and put them into a composite, you can paint a picture that makes you worry. This is where we sat on the August 25th across that range of ratios. This is where it was in 1999 at the end of the tech bull market. This is where it was at the end of the secular bull market of the 50s and 60s, and of course, the late 1920s. We don't like to ignore this stuff. That being said, you can make numbers show a lot of different things. And, our team has been discussing this. We worry about these things every day. As they say, a market can stay irrational longer than you can stay solvent. So it doesn't pay to try and bet against a bull market, although we watch it closely. I've asked James to come on because James and I were talking about this and the different ways you can look at this. And I thought it would be worth having him on to discuss this a little bit.
Thanks, Dave. It's great to join. And as you said, this has been an ongoing discussion amongst us on the investment team for the last little while as some of these valuation charts have made their way around. And it's been interesting to see, it depends on the way that you slice things and the metrics that you choose to use. You can make valuation justify just about any thesis that you would like. And so with this chart, I've just tried to really simplify things and use just a really basic price to earnings ratio for the largest 5 stocks in the S&P to see where things really sit. PE ratios in a vacuum aren't really of much use. They're only useful contextually. You do need to compare the PE ratio to the peer group, to history, against the growth of the company to determine if it's appropriate. But yeah, as I say, with this chart, I just use simple trailing 12-month price to earnings ratio. We're looking at the largest 5 stocks in blue, which represent now just over 30% of the market. And this is showing average PE over the last 5 and a bit years, so since December 2019. Right now, the average PE for those 5 names sits at 36 times versus the market, which sits at 27 times. So over the course of the last almost 6 years, as a lot of these names have drastically outperformed the S&P individually and in aggregate, as you can see from the gray line, which is the equally weighted average of those 5 names. And that's their outperformance over the S&P. So over the course of the last 6 years, the S&P has just more than doubled. So the true cumulative performance for those 5 names is over 700% return. But that gray line is just showing the outperformance. So, the average PE ratio has fluctuated, sometimes higher, sometimes lower, but not really much lower than where it sits now. And I think it's also interesting to look at the spread here. The spread between average PE of the largest 5 stocks and the PE of the market is just about as narrow as it has been at any point over the last few years, sitting at just about 9 turns. So, as I say, there's a million ways to slice and dice the market. There are many different metrics that are useful and that we use in our discussions and in our process. This is just a very simple way to look at things. And when I look at this chart, I don't think the largest 5 stocks in the US are sitting at very scary valuations. That's not to say they can't sell off. That's not to say that we are increasing exposure in any way. As I say, it's just one of the many things that we're looking at and considering. We just wanted to give a bit more look into our process and what we're
Yeah,
thinking about.
PE is, a product of two things. It's a product of price and earnings. And as we've seen quarter over quarter, these big companies have continued to outperform expectation. And so we look at a forward PE, you're comparing the current price to what we expect earnings to be in the future. And if they keep beating the estimates, then it turns out the PE isn't as high as you think it is. So these are all things we think about, and what we found in the 90s, and we had an excellent decade in the 90s, was that these companies were fabulous until they started to behave differently. And that's why we spend so much time with these charts, because we're always watching for signs that they are behaving differently. And at the same time, we're watching to see if there is new leadership that maybe takes over the mantle. And we're balancing this in a series of iterations and portfolios. So I appreciate, James, you jumping on for that. I'm going to bring you back in a little bit.
Thanks,
Thanks.
Steve.
Moving on, global stocks continue to perform really, really well. They've had a bunch of very strong months. That's the developed world ex-US index. MSCI Europe continues to behave well. Japan continues to behave well. This is smaller companies in Japan. This is relative performance versus the S&P. This is definitely a change in behavior. Again, in this past week, 1, 2, 3, 4 great days on to new highs, both relative basis and an absolute basis. Singapore continues to behave really well. Africa continues to outperform dramatically, and of course, there's a little bit of commodity exposure here. China, as we talked about last week, broke out to 3-year new highs, and Peru starting the month really strong again after a very strong August, up almost 13%. TSX continues to march ahead. So a couple things to take away. One, okay, all world index versus the equally weighted S&P is for sure outperforming now over the last 12, 14 months. And that's a change, going back to 2009. And that's why we're now closer to 15% in our tactical accounts in global stocks. Again, over the past week, we reweighted our exposure higher. In our balanced account, I think it's closer to 10, because we think this is relatively early days. And the same for the TSX. We have more Canada in our portfolios than we have had in some times, because they really have made an inflection and turned higher relative to the equal weight S&P. But the other way to look at this is, while the global index has broken out, and this is the MSCI All World ex-US index to new highs. What it tells us when we look at the percent of companies trading above their 200-day moving average, at almost 90% of countries trading in a long-term uptrend, it tells you that the breadth of strength for equities as an asset class continues to get stronger. And our single most important measure of safety in an asset class is that breadth is expanding. There's no bear markets that exist when breadth is expanding. So that can change. But I would say, starting with US stocks having performed so well for so long, but now so many other global markets having joined the rally, that's one of the things that tells me the antidote to some of the inflation concerns is owning equities, because equities companies have the ability to raise price for their goods and to protect their profitability. And the reason we think global stocks can do well on a relative basis is that we are seeing the valuations on global stocks, as cheap as they've been in a long time relative to US. It doesn't mean US stocks have to underperform, but it does mean that we can get performance out of a cohort of countries that have not had strong performance over the last decade and are showing some change. So that's why we are slowly weighting up that global weighting. It's not to say we don't think that we can't make money in the US. We are saying, though, that we think on a relative basis, pretty good risk reward here. And fixed income, we've talked about the fact that we've started to see a little turn in the inflation data, and we're seeing it in the bond market. Now we're sitting here waiting for a Fed rate cut, but when we look at 30-year yields week by week and month by month, they're still ticking higher. So at 4.97 today, or just about actually 5%, we're basically at near-term highs in yields. And if you look at some of the technical indicators, it's an MACD, moving average convergence divergence. It's just turning higher again, meaning it's likely this moves higher. Now, this isn't in a vacuum. You know, whether we're looking at UK gilt yields, new high. German yields, new high. Japanese 30-year bonds, new high. French bonds, new high. Now, a couple of things can impact this. If we think that long-term growth is accelerating, well, that would explain why yields might be going higher. If we think inflation is going to be more persistent and maybe higher, that could explain why bond investors are saying you got to pay us more to take this risk. Or it could be that we just believe that politicians are going to continue to be politicians and be easy on fiscal policy or spending relative to their revenue coming in. Nonetheless, it means that bonds in general have remained risky. And with bond yields going higher everywhere in the world, makes it awfully difficult to make money as a bond investor. So we struggle with this as well, because historically speaking, bonds have been a great risk mitigator in portfolios. And now since 2020, bond prices have been falling. And so you get your coupon, but if your bond price falls, it makes it hard to justify. So in our income portfolios, which have a good record of making money when bond yields are going higher, this is the long-term record of our income strategy. If you took every period where the yield in a 10-year bond was rising, we know that the price of a 10-year bond fell through each of those periods. And we've been fortunate to have positive returns in this income strategy because we can get to things like dividend growth stocks. And, certainly that's added up over time, about 10% a year, a little over since 2000. And, through a bunch of different rolling periods. And as we sit right now, the portfolio is very much a dividend growth strategy. And we think dividend growth looks attractive in a world where the cost of living is going up. On commodities continue to march their way higher. This is the USCI, so the United States Commodities Index. These are monthly bars. Since central banks started cutting almost 14 months ago, it's been a steady stair-step higher in commodity prices in general, led by gold. Again, an asset that tells us investors are hedging themselves for inflation. So we had 4 months of consolidation. In the month of August, things broke out and then followed through to start the month today. It looks like that consolidation's over. And again, the question is, where are we in this rally? Well, we know that central banks have been taking their gold holdings higher, not just through purchases, but of course the price has been going up and it increases the value of their holdings. But it is relevant that for the first time since 1996, central banks are holding more gold in value than they are in treasury bonds. Now, this is courtesy of Tavi Costa at Crescat Capital, who has some excellent charts. We put up a couple of weeks ago that the average fund manager has about a 2% weight allocation to gold. 40% of managers have no gold. I have to think that as this continues, it's going to drag in additional buyers. Certainly silver is following along nicely the way that gold has. And I think that we're in the very early stages of a move higher in silver. This is the last bull market, which was up just over 1,000%. And this move higher in the 70s and 80s, which was up, 1,200%. So we keep this chart in front of us because we think it's important, and not sure we know exactly what to take away from it, but gold turned higher relative to the Nasdaq in 2000, and it outperformed until 2011 for a decade, and then it underperformed for a decade. But we clearly have made a turn here. We did consolidate over a couple of months, but we're starting the month, working its way higher. So gold relative to QQQ looks to be outperforming, and that's why we've been building a weight here. Crude has been an outlier in commodities. It has been now for about 2 years, working its way sideways to down. And we're watching that. We'll talk a little bit about the stocks in a moment, but that's going to be a key component because within the commodity complex, that's an important one. But in general, commodities relative to bonds, very clearly the market's saying the risk is inflation, and so people are positioning for an inflation-oriented portfolio as opposed to owning bonds, which do well in disinflation. Commodities relative to the equally weighted S&P actually have been outperforming here over the last 12 months. So we watch that. We'll see whether we can break out to new highs. And the US dollar, continues to be an underperforming asset, which is good if you own risk assets, because in general, people flood to the US dollar when they don't want to take risk. And when they are willing to put money to work in riskier assets, US dollar tends to weaken versus the basket of world currencies. And looking at a point and figure chart, this is in 2025, you've seen a series of lower highs and lower lows in the US dollar. So we have to assume that that's likely to continue. So look, we don't have to be everywhere. Our job is to identify the most productive areas to put our money to work. We call it market leadership. We watch for change. And as we've discussed over the last 18 months, we've seen some of the commodity related parts of the market behave a little bit better. Some of the global stocks behave a little bit better in an iterative process, building our weights there. There's times when we have to play some defense and hold some cash. This is a pretty tactical approach. Our top-down approach looks at all the different areas we could invest in and focuses our attention in those sectors that are seeing expanding breadth, where over time, more and more securities are performing well. And we're seeing that in global equities. We're seeing that at the sector level, more and more sectors performing well. And then, of course, we try and populate the portfolio using securities from our security selection process that are good, getting better. Things that are showing strong technical characteristics, strong price characteristics, behaving the way they should if we think things are positive, and screening for quality, improving income statements and balance sheets. And of course, that's where our portfolios live, the intersection between strong securities and parts of the market that are showing expanding breadth. And then on the other side, if we start to see deterioration in breadth, it means we got to pull in our horns. And that could happen at the market level. It could happen at the asset class level. It could happen at the sector level. But when breadth starts to contract, we get a little bit more cautious. So here we are heading into September. And there's a lot of green on the screen. So I worry like everybody else, seasonally when we get to a tough time of the year. I worry when I see some of the valuations that get put on markets. But, there's no bear markets that happen when things look like this. In January of 2000, when the Nasdaq rolled over for the tech wreck, the indicators looked nothing like this. They were red across the board. Breadth was contracting. In the summer of 2007, leading up to the financial crisis, breadth started to contract in financials a full year before the market cared. But financials underperformed during that year. In March of 2008, breadth started to contract for the NYSE. The percent of stocks in uptrend started to move to the left. And it was 6 months before we were in a significant decline. But as we sit today, all of these things are improving. And all we can do is watch these week to week. And if we start to see the percent of stocks trading above their 50-day moving average or intermediate term trend start to weaken, well, we'll start to care. And if the percent of stocks with upward trajectory or momentum starts to wane, we'll see it. And you'll see it on this webcast. But as it sits right now, heading into the toughest time of year, things don't look so bad. Let's look at leadership. Financials are rock solid. This is the XLF ETF, broad-based financials ETF, continues to be about the strongest, most resilient group in the market. Partly that's because they benefit when long-term yields go up and short-term yields stay low. So you're getting Fed cuts on the low end and the bond market's taking yields up on the high end. And that means if you're a lender, you pay a small amount on deposits and you lend it out for more money and you make a bigger spread. So last week, boy, what a great week for Canadian banks. The Canadian banks reported, Royal Bank, very strong week. CIBC reported very strong week. BMO reported very strong week. Things look pretty good, and these companies are raising their dividends. On industrials, this is the equally weighted basket of industrials in the US. Relative strength versus the S&P has been in line. So it's a constructive price chart. Relative performance has been about sideways, but it's a broken up group. You've got aerospace and defense on the strong side. We've seen pretty consistent improvement in relative price. We're basically at new highs. And companies like GE Aerospace are benefiting here. But on the other side, transports, which perhaps are a measure of what's going on with trade, have been weak. And so that's made up of, companies like Union Pacific and Norfolk Southern, the airlines like UAL and Delta, and of course Uber fits in there, which is actually a pretty big weight. So we watch that. We don't have a lot of transports. On the materials, the senior gold producers are really sort of rolling. This is the Sprott Gold Miners ETF. Relative strength at a new high today. The price hit a new high. No sign of a slowdown here. This has been really quite a breathtaking rally and doesn't show any sign of weakening. Agnico Eagle, which is our biggest weight, new highs today. Kinross, new highs today. Alamos Gold, boy, after that consolidation broke out 2 weeks ago and really rallying nicely. And the producers, relative to the gold itself, are doing exactly what they should do in a bull market. They're rallying. We're finally seeing some flows coming into the ETFs. That's a change. That's supportive of prices going higher. And from a valuation perspective, if we plug in the most recent price, well, we did hit 3,600 today, but the margin between the all-in sustaining costs and the current gold price means these companies are generating a boatload of cash. Copper producers had a very strong month in the month of August, up 13%. Started the month positive again today. Hudbay, we've talked a little bit about as a mid-sized producer, $6 billion company that recently got funded for their project in Arizona. Freeport is behaving a little bit better. The whole group, the metals and miners in general, have broken out of a multi-year bear market, and the uranium producers also, look pretty darn strong. So, the truth is, we've been watching this and talking about it, and you may get sick of hearing about it, but the fact is, the mining industry as a percent of global equity is only 1% of the world market. That reflects, how many owners there are, not many. And when you get a bull market, very often this becomes a much bigger part of the market. So we think that there's a long way that this can go. Communication stocks, continue in general to improve. That this is the group that, of course, it holds Meta and Google and Netflix. Google continues to be very, very strong, nice improving relative strength. This fits the kind of company we're looking for, a company that is growing its cash flow. Cash flow per share in 2024, $9.20, 2023, $6.80. Earnings for 25 are expected to be up 28%. This is a group that is generating cash and doesn't need debt. Now, overall, technology has been a little weaker on a relative basis. Boy, we hit new highs only 2 weeks ago. So we watched that. And the semiconductors, have consolidated a little bit here. Last week, before Nvidia reported, I had James on. He talked about some of his expectations, and I thought I'd bring him back today just to talk us through, what came out of the earnings report, what people are thinking about in the short run, what people are thinking in the longer run, and what our thesis is going forward here.
Yeah, thanks, Dave. Happy to come back on. So yeah, last week in anticipation of the Nvidia earnings, I just talked through some of the things that we were looking for. We ended up getting most of the things that we were looking for. The expected trading range based on the options market was about plus or minus 5% in the post. And the stock traded inside of that range, which is rare and always shows when that happens that there are some debates taking place, and that can be healthy. So in the print, I only saw one area of softness, and that was on current quarter, so second quarter for them, data center revenue. That came in just very slightly light. Gaming segment revenue was big enough for the company to still deliver a beat on total revenue, though. It does seem like guidance for next quarter revenue was maybe a bit light of what the market was looking for, but Nvidia didn't include any of the China-specific chip sales in guidance, which represents about a $15 billion opportunity for the rest of the year, given that they didn't sell any of the chip in the second quarter as well, which that was not known. So that makes up the difference between what would have been a big guidance beat and what was perceived as slightly light guidance. Besides that, margins came in line with expectations at about 74% on the gross margin, which is amazing for a business as complex as this. And the company announced a $60 billion share buyback. There's not really a good reason here as to why they're not raising their dividend. They pay just a small nominal dividend now, but with the earnings growth and the free cash flow growth that Nvidia has seen, they could be a big dividend grower, and my hope would be that they look to do that at some point. So that's something that we'll continue to watch for. But
Just from my standpoint, I think it's interesting. Okay, so they report a 54% earnings bump on the quarter. If you look here on the chart for the 2026 estimates, $4.50, up 51%. These arrows are the last three earnings revisions. The last three earnings revisions for 26 are higher, and the last three revisions for 2027 are higher, expecting earnings growth of just over 40%. Now, these numbers are irrelevant, but they do have a pretty consistent history of beating the numbers. So when I look at the semi sector, and we know that it has been unable to really make a new high, but you see that Nvidia clearly made new highs and is sitting here basically at the 50-day moving average. Pretty hard not to be constructive if you're going to have some exposure in semiconductors to be in the leader in the group.
that's
And
right. And
groups
I
can
would say
always
on the
correct,
numbers,
but own the leaders.
yeah, and I would say on the numbers, just very broadly, numbers very strong. Growth is very solid. Revenue growth more than 55% year over year. That's a healthy read through for the rest of the space, which is also important. And all the industries relying on AI-driven CapEx to continue to work. So it was good. Maybe, Dave, we can take a stab at one of the questions that's come in. So the question is, will you add to your chip exposure as Nvidia pulls back? And what's our top pick in the sector? And to that, I would say, it's not really our intention here to add more chip exposure right now. When you look across the semi industry, and Dave, you put up a lot of good charts on this, there aren't names that have performed as well as Nvidia and Broadcom. Those names have been our core semi holdings. We've made some great money for clients owning those two names. We own them pretty well everywhere that it's suitable. And to be honest, I don't see too much that I like inside of semis between those two. So no, I think we would be inclined to put money to work elsewhere.
Yeah. Well, this is the nice thing about this market, right, James? I mean, there's other sectors that are performing well, and just to move on that topic, this is the XEG ETF, which is the Canadian energy sector. We've talked about the fact that it has been consolidating now over the last, 18 months. We got briefly up and over this trend and consolidate along the top side, but in the last couple of weeks, looks as though we are starting to move away to the upside. If we look at the market breadth, and this is an important market, certainly in the Canadian market, certainly globally, and if you believe that inflation is likely to stay sticky, when we look at the U.S. S&P energy sector, okay, a little stronger than we've seen over the last few weeks. But when we look at the percent of stocks trading above their 200-day moving average, as of this morning before market opened, 64% of companies now above the 200-day. So we're seeing a nice pickup in the percent of stocks trading above their long-term trend, and that's favorable. So, we've talked about Imperial Oil as one that continually was making new highs. We also own some CNQ and a couple of other names. We added a little bit more energy exposure this morning here. We'll see. But that is constructive, and nice to see that broadening as well. On the other side, consumer staples continues to be very weak from a relative strength perspective. Two things to take away from that. Market's not telling us that we think that there's a big market problem, because If people were getting defensive, they'd probably be buying consumer staples. No joy in Mudville in real estate land. Real estate continues to be sloppy from a relative price perspective. That's REITs. Utilities, did have a nice move higher in price, but on a relative basis, no sustained relative strength here. Again, that would be a group that would tend to do well if the bond market started to do a little better because it's a high dividend paying group, or if we thought that the economy was going off a cliff, and that does not appear to be the case. And one group that we're watching, we've done nothing on, a little bit of improvement in relative strength in consumer discretionary. It's obviously a big sector, not enough to cause us to do something yet. So look, on the 11th of August, the average sector had 45% of stocks in uptrends. And there were a lot of sectors in small letters, which means breadth was contracting. Fast forward to last week, the average sector had 48% of stocks in uptrends. More sectors in capital letters improving. Of course, the strongest sectors on the far right side, the best breadth. And if we look at today, moved a little further to the right, the average sector with almost 50% of stocks in uptrends, a lot more sectors in capital letters, a lot in green, meaning strong relative to the market. And so again, things just generally improving into a difficult time of the year. So financials continue to be our largest weight. No change here. Industrials continue to be our second biggest sector weight. This has now some global industrial exposure in it. Technology, has been pretty steadily about a third market weight over the last few months, because we do think that there are other things to do that give us good diversification. Materials, growing 11% versus 2.5% the S&P. And that's a combination of precious metals and some copper and some uranium. Communications, been pretty consistent and a little slight overweight versus the market. Energy, well, we'll see if this comes up a little over the next few weeks, see if we get some fall through there. On the other side, consumer discretionary, very small. Consumer staples, very small. Healthcare, very small. Utilities, very small. Real estate, very small. And, corporate bonds, this is really represents exposure that we have to have in our balanced portfolio. Really no government bonds to speak of. So our portfolios are balanced. They're balanced with Canada, US, and now global equity exposure. They're hedged against inflation with energy and materials, commodities exposure, which is a hedge. And we don't have a lot of interest rate risk. Now, if we look at the risk indicators like the corporate bond spreads, they continue to be very narrow, meaning that corporate bond investors are not worried about getting paid back. In the month of August, the spreads widened very, very slightly from a multi-year low. So we'll watch that. Again, we don't have a lot of bond exposure. And volatility, is sitting right in the middle of the range that we have in the best of the cyclical bull markets. So this is all about evidence. It's not about opinion. I would say that the world is looking forward to additional rate cuts. That's liquidity. The world is moving assets towards things that protect them from inflation. And I think we're there. And things continue to be pretty constructive. If things get more difficult, well, you'll hear the tone in our voice on our weekly webcast coming up. And you'll see us change our weightings because we do have a tendency of playing defense when things get more difficult. With that, why don't we see if we've got some questions? And if I can't answer them, maybe James can. Peter is asking, with the breakout in the commodity sector, which segments are you most likely to add to in the portfolio over the next 30 days? And the question is, gold, silver, copper, or oil and gas. So I think that we have a pretty solid weight in precious metals between physical gold, ETF, PHYS, and our holdings, Agnico, Kinross, Wheaton Precious Metals, and Alamos. I think we have pretty solid exposure by account. We do have some copper exposure. I suppose if it got going, we might consider adding a little bit more, but I think that we have good copper exposure with Hud Bay and with Freeport. We have a little bit of uranium exposure through Cameco. And we have, some oil and gas exposure, but largely in the large integrateds where we're getting great dividends and dividend growth. I suppose if energy were to wake up here, we might consider adding some more energy exposure, but we have Cheniere for the natural gas infrastructure. So I think we're in pretty good spot there. I don't think most investors are. I think we are well ahead of the curve, and sometimes maybe we're a little too far ahead in our initial allocations, but it's certainly paying off now. Do we still own CrowdStrike? No, we do not. We got stopped out of that. I think I mentioned that on the webcast 2 or 3 weeks ago. Yeah, the post-earnings response was not overly positive, and with our view, a little bit more neutral on tech, we moved on. And another question is, would we be a buyer of Celestica? Look, there's the weekly chart on Celestica. Boy, what a great move and great relative strength. Company has consistently beat. The estimate for 25 is up 54%. Estimate for 26 is up 21%. Celestica has been a big beneficiary of the build out of data centers. So they've been involved in those build outs. It's a company that we could own if we were adding more in the tech space. And I guess that's a good question. We've sort of been adding in other areas, but boy, I'd have no problem owning it at this point. Good question.
Maybe I'll just jump on because Dave, you and I haven't spoken about this one personally, but
Yeah.
we did add some Celestica to the equity mandate last week. So
Oh, I missed it.
we
Okay.
we've been thinking the same thing, and it's one that I know our Canadian analysts have talked a lot about, and it's been a big focus for Amit specifically. It's always
Must have
hard to
happened
add a
when I was
name.
in Ottawa.
It was on that day. So it's hard to add a name like this when it is up on a stick as it has been. But doing the fundamental work, we know a lot about the industry as well. It just made sense to add it. The growth is really strong, and it does stand out as being unique to have that sort of AI proliferation, data center exposure inside of Canada is rare. So
Yeah, I
that's in the
didn't I
equity
didn't
mandate
see
now.
this over the last 10 days. I knew that it was setting up, so good move, guys. Good move. Let's see. You mentioned owning trades before they're popular. Are you interested in transports now? Freight recession can't last forever. Lots of good deals today, including Transforce and CN Rail. I think the thing here is we like to see improving breadth within a sector before we make an entrance. And we just can't point to that right now. So, a lot of times we'll get questions about, a sector's way down. Is it time to buy it? And I would prefer to see some improved relative performance and some improved breadth within a sector before we put on new positions. And especially when you're in a market where there are other things to do, market's pretty good right now. So what does it tell you if the market's pretty good right now and the transports are not participating? If the market were to weaken, a group that's under participating going into a weaker market is not likely to become leadership, and especially if the major concern would be, economic slowdown. So at this point, no, we're not adding anything on the transport side. And then the last question is, why has tech resources underperformed? Well, I think that there are some concerns about copper companies that are not specifically US domiciled. I think that's one of the issues. Tech has been getting their here's what I found. Their newer mine up and running and getting the bugs out of it. That's part of it as well. They've had some weaker production numbers in general. It's a company that I think a lot of and would like to own, but we don't own it currently for those reasons. And I think that's it. I think we answered all the questions. James, thanks so much for joining us. Folks, if we haven't had a conversation with you recently and you'd like to have an update, we would certainly love to touch base. I know that Tiffany and Shavana have been busy working on a pretty detailed financial plans for most of you. And I know you're in various stages of that. If we haven't done that with you and you'd like to, please let us know. And if you're too shy to ask a question on the webcast, reach out to us directly. We're certainly available. We try to make time to talk to anybody who'd like to have a conversation. So thanks very much, and we'll look forward to seeing you again next week.